Hi guys, today we will discuss Long Strangle. Now as you can see from my Udemy profile, I have many courses on option strategies. Now why did I make so many courses? Because I have seen firsthand that hedge fund, mutual fund, high net worth client uses option strategies to the core. They use it every day, every week, every month. They do lose money, but they are using it so much that its success ratios is really great. And if you will trade them, then you will also know that out of 10 trades, you will have 2 losing trades. And that is a loss fixed trade. So your losses are fixed, but your profits are unlimited. So your risk is really gone. You don't have to do anything. Even if I have took a loss of say $100, the next trade can really come up with $300 in profit. So at the end of the day, I'm getting income. Now these strategies are income strategies. So if you place a trade every month with let's say 15 days expiry or 30 days expiry, then you have a higher chance to make money. The best part, let's presume you make a trade with 30 days expiry period. Now over time, the options premium starts to get reduced. So if you invested let's say $2 premium per option contract, so $4 in total for 2 contracts, after 10 days the premium will get reduced as it comes nearer to its expiry period. It will be reduced from $2 to $1. So if you square it by buying the opposite option, you are basically getting paid. So at the end of the day, you initially paid $2 and the option time spread reduced it. So you got paid $1 for it. And that's the best part. Another thing is American options. In American options, you can claim it any day you like. You don't need to wait for the expiry period. Yes, your money will be invested, but at the end of the day, if the price is moving with your game plan, you can suddenly book in the profit. Example, let's look at it here. We are seeing that the price is currently moving within the Bollinger Band. Now right here, it has crossed on the top. Once it crosses on the top, we know it's our lucky day. Now, you might be thinking how to select a stock. I would suggest you to pick top 10 blue chip companies. Blue chip means good companies which you have seen on the main street. Example, in the US, Bank of America Corporation, Coca-Cola, Pepsi, or companies which are renowned. And every day, take out 15 minutes, just look at their charts and try to find this kind of candle which goes beyond the Bollinger Band top band. That's it. Nothing else. Absolutely nothing else. Just look at it, all the charts, the top 10 companies that you have picked every day. Don't invest in them. Just wait. Look at them, look at them, look at them. Once you find this thing, put the option contract. Now we are discussing Strangle. So in Strangle, you have 2 option contract. One is put, one is call. So you put the put contract right at this end on the middle Bollinger Band. At 15, let's take it 1550, because usually it's a round number game. So you will find 1550 or 1575 on the options chain. So let's take 1550. The next option contract that you make is the call option contract. Make it today's price close is at 16. try to find 1620 or 1610, like nearer to your closing price. If you can find an option contract at 16, awesome. 1610, no problem. The point is nearer to your closing price. Now we have put in two options contract. This green is call option and this red is put option. Okay. Now as per like the long strangle, we need the price to stay out of this band, that is this lower band, this higher band. You can even reduce this band from 1550 to 1575. Why? Because basically you are targeting it to stay out of the band, right? So the smaller the band, the higher the chances. But let me take it to 1550. I want to show you like a really risky game, and through my plan I want to show you how successful it is. Reason being, you can always reduce it to make a good option chain and make a profit easily. But what to do if things go wrong? That's why I'm selecting a far higher band. Now let's look what happens next. First day, it's now out of a band. 2 days, 3 days, 4 days, 5 days. 6, 7, 8, 9, 10. Now usually in a week there are 5 working days. So 10 days means 2 weeks have passed. 11, 12, 13, 14, 15. 3 weeks have passed. 16, 17, 18, 19, 20. Approximately a month have passed. And now what do you see? You see that an expiry date of 30 days, you are currently trading at 1648. Where did you trade? You traded at 1611. That's approximately 37 cents profit. Right? An awesome profit. You can easily sell it on the top and make good money without any doubt on the expiry date. This is the first scenario. Second scenario, as the price moved up, and let's say it's a $16 like option chain, so it will be let's say 20-25 cents in like both premiums. So you will have your break even point, let's say at 1630. So once the price goes up, on that day you can square it out, the options, and book your profit right here at 1656. Without waiting for this expiry period, you simply square your options out. Just look at the time spread. You paid 20 cents, 10 cents for each like option contract. 2 options contract means 20 cents. Once it goes above and you are in profit, let's book your profit at 50 cents. So 1670 would have been 50 cents. Right here on this day, you simply check out the option time spread and you square your options on that day. Once you do, you claim the option on one side and get your profit fixed. What do I mean? Now, if both these options expire worthless and the price ends in between, right here, example this date, then it says that you have lost your premium that you paid up front. If the price ends outside, then you can simply claim this call option, and this call option was placed at 1610, so your buying becomes 1610, and let's say you exercise the option right here, so at 1677 you can sell on that day. So you got to keep a 57 cents profit. Boom, on this day. And you paid 30 cents in like premium. So you got a 37-cent profit. So basically, you can claim it right there. As we discussed in the time spread chapter, with time the option premium will start to get reduced. So if you paid 16 cents for buying an option, then for selling an option you could be paid 8 cents. So once you are paid 8 cents to square that option, the other side, so if you paid 30 cents, example, let me put it right here, text. Let's presume we paid 10 cents for this call option. Okay? And we paid 10 cents here as well for the put option. Now once the price goes to this end, with times period, as we claimed, as we like entered the option contract right here, so it's like 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 or 13. So after 13 days, it will not be 10 cents. It would have been reduced to 3 or 4 cents. Why? Because your expiry period is far nearer. So they can expire. So you can just go into the market, and because you bought these options, so you paid for them. If you sold these options, you will be paid, right? So let's presume the options that are now priced at 5 cents. So if you like buy this put option out, you would be paid 5 cents. But you won't be squaring this option because you will be utilizing this option by saying that okay, sell me the stock at 16.10, and you will simply sell it on that day at a higher rate. So basically you pay 20 cents, you earned 5 cents by like selling the put option, which literally squared these two options. So your cost is reduced to 15 cents. But as the price is higher, so simply bought it at 16.10 and sold it at 16.77. So your profits got increased. Now let's presume you don't square it. You wait for the expiry date. Then even 20 cents, this 5 cents won't be there for you. Why? Because on expiry date you don't need to square it out. So only these two will be there, that you paid 20 cents. So your cost will be increased, like with your cost, the price will be increased to 16.30 and you are squaring it at 16.48. So basically you earned 18 cents on the trade, and you are utilizing this trade every month, so you are getting paid every month, and it acts like your passive income. So now you learned the 3 techniques of option players. How I learned them? I learned them by like looking at hedge funds, mutual funds, and even high net worth clients. I've seen them that they would have bought it here and the price would have like gone straight, gone up, and once it would have reached up, they would have started to square it out. Because they were not trading one option, they were trading thousands of options. You as an investor on the flip side is trading only one option. So you can square it like at any day. You are like the guerrilla force. You don't have any problem. But a hedge fund is like an army. They have to keep an eye on it because they have like huge forces. Let's say 100 options. They know they cannot simply square it out. So they start to square it on this day, 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 and the rest get expired on the expiry date. This is their point. And the best part is, as the price went above the Bollinger Band, you know that the trend is up. So there is a like higher odds of the price ending above this call option and giving you a profit. Because if it ends in between, you are in total loss. But if it stays above, you get to have a smaller loss. And once it reaches 20 cents, that is, this is 1610, at 1630, it's break even. So beyond 1630, you are always in profit. But even if it ended above like this green line, then your losses gets reduced. The best point. Now let's see what happens next. Can we find another trade? Right here. Right here, we will trade a second long strangle options. The same way, we put the call option on the closing price, $18, and the put option right here at 17. Why? Because there is a huge gap. Now usually I would put the option contract right here. Why? Because if the price opens higher, usually it comes back to fill it. But I will put it at the same closing price with this put option at a lower rate. Now let's assume we paid 15 cents each. That is 15 cents for this put contract and 15 cents for this call contract. Now what happens next? One day up, 2, 3, 4, 5, 6. 6 days up. And where are you? You bought it at $18. And your cost is 30 cents. So your break even point would have been 1630. Sorry, 1830. Right here. I don't know where the line went. Wait a minute. $18.30. Now my point of view is above $18.30 you can claim it any day you like. 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. Now 18, 19, 20. This would have been the expiry date of our option, this last date. Huge profit. Now just look at it closely. What do you see? This D is for dividend. That means that on 30th November was the ex-dividend date or result date. Payment date is December 30th. So basically you follow these dates, the ex-dividend dates, because usually the price rises and then it gets X'd to a reduced price. So this is your game plan. Wait for it. You could have squared it right here and earned a handsome profit, or you could have waited and on the expiry date you could have earned a higher profit. But the concept is this plan is profitable, mostly profitable. Why? Because once it goes beyond the Bollinger Band, it tells you that it's like in an upward trend movement. And with a 30 days expiry period, you have a higher chance to make a good profit. Because right here on this trade, you could have like simply bought it at 18 and sold on expiry at 22.57. So that's 18, 19, 20, 21, 22, $4.57. Your cost 30 cents. $4.27. One option contract is $100. So it would have increased your profits to $427 without anything. You just keep an eye on it, and at the end of the month it would have given you a huge profit. And for the rest of the days you would just sit on the sideline and just look at it. If it comes on the right moment, you buy the options contract. Otherwise you just say, okay, no problem, I'm not trading. So these are the real important things. because basically on any website you'll only find them telling you, okay, buy this put contract, you pay X premium, buy a call contract, you pay X premium, that's it. But how would you know? Example, we traded at a certain specific point, but what if you would have traded it right on this day, this candle, for like 20 days, it would have stuck in between the Bollinger Band, and there would have been a higher chance that you could have lost everything, the full premium. Whereas in my plan, from day one, it remained outside your band, because if it like this is your band, it is from first day outside the band, no problem at all. Example, a first option contract right here. This day we traded it on the close 1610. It remained outside for 3 days, then it came back in 3 days, then it went out again. So basically we were not in trouble from day one. It was always helping us out, even though it came back in, but it went out because the long term trend was outside. That's why I love Bollinger Band, and I would suggest you to follow it. It will help you make good money. Thank you.